Welcome to ZICA Academy YouTube channel. In this lecture, I want to examine consolidated statement of cash flows, the acquisition of subsidiary during the year. If you are coming across my lecture for the first time, please make sure you like the video and also share it with others. If you are a returning subscriber, I say thank you for being part of this channel. The following are the features of group financial statement that distinguish group financial statements from the financial statement of a single entity. Number one, we have the goodwill. Where there is an acquisition of subsidiary, then goodwill will be calculated, which is the excess of purchase consideration over the fair value of the identifiable net assets acquired. Then another feature that is peculiar to group financial statement is investment in an associate. Investment in associate, where there is an associate. That is, the investor acquires a significant influence in the investee. Then you have an associate. Then another features of group is the retained earnings. Retained earnings. Attributable. Attributable to the parent. Then number four, then you have the non-controlling interest. That is, you will only have the non-controlling interest in the case of a partial acquisition. Non-controlling interest is the part of the equity interest of the subsidiary which are not owned either directly or indirectly by the parents. Remember, the statement of cash flows are prepared under three separate headings. Number one is operating activities. Please, for completeness, I will advise you watch my earlier presentation on statement of cash flows of a single entity, because I will not repeat those aspects that were covered in the statement of cash flows of a single entity. I will only examine those features, additional features that are peculiar to the group, which will not be found in the statement of cash flows of a single entity. Number one is goodwill. Where there is an acquisition of subsidiary during the year, you will need to calculate goodwill. So working one, goodwill on acquisition of subsidiary. Goodwill on acquisition of subsidiary. Then you start with the purchase consideration. Purchase consideration. Remember, if you have watched my earlier presentation on group accounts, I've told you that the purchase consideration can be divided into one. We have cash consideration. So in case you have the cash consideration, so you have it here. Then you may also have deferred consideration. So I've told you where it is deferred consideration, you need the present value of deferred consideration. I've told you that the deferred consideration is the consideration that is not to be paid immediately. The one that is to be paid in future. That is deferred consideration. You need the present value. That means you will need to discount your deferred consideration to its present value. Then the present value of the deferred consideration is what will be used in calculating goodwill here. Then number three, you have the share consideration. Share consideration. Where the parent company issue part of its own shares as a consideration for shares acquired in subsidiary, then you will need the share consideration here. The market value, it is the market value of the share consideration that will be used. Then number four, we have the contingent consideration. Contingent consideration. That is additional consideration that will be settled or paid upon the happening of uncertainty. It is the fair value of the contingent consideration that should form part of the consideration for goodwill. Then after this is the total consideration. Then you add the non-controlling interest. Non-controlling interest. So where the policy is fair value, you'll be given the non-controlling interest or the information to calculate it. So where the policy is proportionate, just apply the percentage attributable to the non-controlling interest on the fair value or market value of the net asset of the subsidiary acquired. So, or at the date of acquisition. Then, now subtract the fair value of net assets at the date of acquisition. All these have been explained on my earlier video on group financial statements. So this is the goodwill on acquisition of subsidiary. Goodwill. Then you will now need to determine the movement in goodwill. Working 2. Movement in goodwill. Remember, the calculated goodwill here is the goodwill of the subsidiary that is acquired during the year. So, remember, for the purpose of statement of cash flows, you'll be given the prepared statement of profit or loss and the prepared statement of financial position, where you have the goodwill. The goodwill will appear under non-current assets in the statement of financial position of the individual parent, of the individual entity, that is, of the parent and of the subsidiary. So, remember, in all our workings, we normally start with the opening balance. The opening balance is the opening statement of financial position, while the closing balance are the balances in the closing statement of financial position. So, you start with the opening balance. Opening balance. The opening balance here is the goodwill in the opening statement of financial position. So you take that figure there, you will see that under non-current assets. Then you have goodwill of subsidiary acquired. Subsidiary acquired. As calculated from working 1. The goodwill obtained here. Let me put working 1. So you add that. Then you now have closing balance. Closing balance. That is the goodwill in the closing statement of financial position. Then if you subtract the closing balance, it is possible the total here may be greater than the closing balance. In that case, you have goodwill written off or impairment of goodwill. Goodwill written off or impairment loss. This amount will be adjusted in operating activities. If you are using indirect method, you will add this amount, the figure obtained here, the goodwill written off, you will add that under the adjustment for non-cash items, because it is a non-cash items. That is number 1. Then the second item is investment in associates. Working number 3. Investment in associates will be used in calculating dividend received from associates. Let me have movement in investment in associates. In the movement in investment in associates, then you start with the opening balance. This opening balance will equally be found under non-current asset. Opening balance. You will see that under non-current asset where you have an associate. Then you now go back to the statement of profit or loss. You will see the share of profit of associate in the statement of profit or loss before the profit before tax. So you put share of the profit. If it is profit, you add it, or loss minus, in case of the loss, of the associate. So this figure will be obtained from statement of profit or loss. You get this amount from there. Then you have the closing balance. Closing balance under non-current assets. So you start with this, you take the closing balance rather. So after subtracting this, you get the dividend received from associates. This amount will be shown under investing activity. You report the amount as investing activities. Then working number 4. Then we have retained earnings attributable to the parent. The retained earnings attributable to the parent will be used to calculate the dividend paid to the parent, to the owners of the parent company. Movement in retained earnings attributable to the parent. Remember, retained earnings will be found in the equity section of the statement of financial position. Then you start with the opening balance. Under equity, opening balance. Remember, I've told you the opening balance will be found in the opening statement of financial position. Then we have parent share of the profit for the year. Parent share of the profit. You add the profit if it is profit. If it is loss, you subtract. Parent share of profit or loss for the year. This amount will be obtained from the statement of profit or loss. Then you add. Then you have the closing balance. Closing balance. Then if you subtract the closing balance, you have dividends paid to the owners of parent. This amount will be reported under financing activity. Report this under financing activities. Okay, number 5. We have movement in non-controlling interest. Movement in non-controlling interest. Then you start with the opening balance, which will be found in equity section of the statement of financial position. Then you go to the statement of profit or loss. You have the NCI share of profit or loss, minus in the case of loss, profit or loss for the year. This amount will be obtained from the statement of profit or loss. You add that. Then NCI of subsidiary acquired during the year. Then this amount, if it is fair value, will be given, or the information to calculate it will be provided. You use the figure, the fair value as provided, or the information, you calculate it as required by virtue of the information. Or you apply NCI percentage if the policy is proportionate. NCI percentage times net assets at the date of acquisition. So, either you use the fair value of NCI, where the policy is fair value, or you apply the percentage attributable to NCI or the net assets at the date of acquisition. That is the net assets of the subsidiary acquired during the year. So you add this, then you have the closing balance. Closing balance, we have, if you subtract the closing balance, you have this. That is dividend paid to NCI. Dividend paid to NCI. You report this under financing activity. You report it under financing activity. Working number 6. We have acquisition of subsidiary, net of cash acquired. This will need to be calculated where there are acquisition of subsidiary during the year. Then you have cash consideration. It is the cash element alone that will be considered. The cash consideration. Then cash, you less cash acquired from subsidiary. Where cash are acquired from subsidiary, you subtract this. Where bank balance is acquired. Bank balance acquired from subsidiary. You subtract this. Remember, I've told you are considering only the cash element of the purchase consideration. You have this information where you have information about the subsidiary acquired. Then bank overdraft. Bank overdraft acquired from subsidiary. You have cash paid on acquisition of the subsidiary. This is the net amount. This will be reported under investing activities. Then, let me include this, work number 7. When you get to changes in working capital, changes in working capital, you are considering the movement in your assets, current assets and current liabilities. So you might have increase or decrease. Increase or decrease in inventory. You have the opening balance plus acquisition minus closing balance. Plus acquisition means where inventories are acquired from the subsidiary during the year, you have to add the one acquired to the opening balance. Where the total of these two are greater than this, then you have a decrease. But where this is greater than the total here, then you have an increase. Increase, remember, is minus, while decrease is plus. So same is applicable to receivables, increase or decrease in receivables. These items will appear under operating activities. Then increase or decrease in payables. Opening balance plus acquisition minus closing balance. Remember, decrease is is minus. Payable is a liability. Liability is opposite of asset. Decrease minus. Y increase plus. The OB stands for opening balance. A stands for acquisition. That is the one acquired during the year. You will see that where you have information about the acquisition of subsidiary during the year. The CB stands for closing balance. Closing balance. I will now repeat the format for the preparation of statement of cash flows, since that has been given in the cash flows of a single entity. Other workings not shown here have been done in the statement of cash flows of a single entity. I want to take a work example. Keep watching. Example: the draft statements of financial position and statement of profit or loss of the grape group at 31st March year 4 and 31st March year 3 are as follows. You have notes, you have year 4, year 3, amount in $1,000. Non-current assets, which include intangible assets, $24,000 for year 4. Property, plant, and equipment, $13,515 and $12,990 for year 4 and year 3 respectively. Investments associated undertakings, $1,966 and $1,920. Total of the non-current asset is $15,505 and $14,910. Current assets, inventory, $11,657 and $10,530. Receivables, $7,209 and $6,936. Cash at bank and in hand, $5,190 and $1,728. Total of current assets is $24,056 and $19,194. Total assets, $39,561 and $34,104. Capital and reserves. Share capital, $8,100 and $7,425. Share premium, $1,989 and $1,470. Accumulated profits, $13,200 and $8,700. Then the total equity is $23,289 and $1,759. We have non-current liabilities, note 2, which is $6,900 and $7,890. Then current liabilities, $9,372 and $8,619. Total equity and liabilities, we have $39,561 and $34,104. Statement of profit or loss, year to 31st March, year 4 and year 3, amount in $1,000. Sales revenue, $74,100 and $59,400. Cost of sales, $54,138 and $42,240. Gross profit, $19,962 and $17,160. Distribution cost, $5,889 and $4,869. Administrative expenses, $4,092 and $3,384. Operating profit, $9,981 and $8,907. Income from interest in associates, $139 and $144. Loss on sale of tangible non-current assets, $18,000. Interest expense, $552 and $651. Profit before tax, $9,550 and $8,400. Income tax expense, $2,950 and $2,400. Then profit after tax, $6,600 and $6,000. We have notes. Note 1. Property, plant, and equipment, year 4 and year 3, amount in $1,000. Cost at 1st of April, we have $20,598 and $19,416. Additions, $1,875 and $2,022. Disposals, $429 and $840. At 31st March, we have $22,044, we have $20,598. Depreciation at 1st of April, we have 7,608 and 6,094. We have charge for the year, 1,176 and 936. We have disposals, 255 and 312. At 31st March, 8,529 and 7,608. We have net book value, 13,515 and 12,990. Note 2, no current liabilities. We have year 4 and year 3 amount in $1,000. 8% loan notes, 6,900 and 6,900. 10% unsecured loan notes, 990 for year 3. Then the no current liability totaled 6,900 and 7,890. Note 3, current liabilities, account payables 6,422 and 6,219. Income tax 2,950 and 2,400. The total of the current liabilities is 9,372 and 8,619. You are provided with the following additional information. The first asterisk, interest on the 8% loan notes is payable half yearly on 30th of September and 31st of March. Note the second asterisk, income tax is payable 9 months after the year end. The third asterisk, dividends of $2.1 million and $2.4 million were proposed for the year 3 and year 4 respectively. The fourth asterisk, during the year, the Grape Group acquired 100% of the ordinary share capital of PIPE. The purchase was financed by $346,000 in cash and the issue of 54,000 ordinary shares of $1 each. The ordinary share had a market value of $152,000. The following figures related to PIPE at the date of acquisition amount in $1,000. Property, plant and equipment, 315. Inventory, 139. Receivables, 85. Cash at bank and in hand, 3. Payables, 68. Total, 474. Share capital, 180. Reserves, 294. Total, 474. Note 4. The share capital consists of $1 ordinary shares required. Prepare a statement of cash flows and the related notes for the Grape Group for the year ended 31st March, year 4. You want to prepare statement of cash flows for Grape Group for March, for the year ended March 31st, year 4. Now let's have the solution to the question. Grape Group consolidated statement of cash flows for the year ended March 31st, year 4. So the first heading will be the operating activities. I've told you that operating activities are those activities that arises in the normal course of business. For better understanding, I would advise you watch my videos on cash flows for single company, both direct and indirect method. So operating activities. I've told you that you will need to start with profit before tax. You are given year 3 and year 4. Year 3 is a comparative figure. So year 3 is not, the statement of profit or loss for year 3 is not relevant. Anytime you are given a comparative statement of cash flow, statement of profit or loss, like this, the profit or loss for the preceding year is not relevant. This is just a comparative year. The profit or loss for the comparative year is not relevant. It's only the statement of financial position you will need for the 2 years. So that of year 4 alone will be relevant. So profit before tax, that is 9,550. So we have profit before tax, 9,550. Then you now have adjustments. Adjustments. Remember, I've told you that there are 3 number of items that will require adjustments. Number 1, we have the non-cash items. Number 2, items to be treated net of operating activities. Number 3, we have changes in working capital. Those are the 3 items that will require adjustment here. So it is those ones that have a bearing on profit before tax that will require adjustment. Anything whose effect, those items whose effect are on the profit before tax are those items that will require adjustment. If their effects are not on profit before tax, that means you will not need to adjust them here. Now, let's go through the profit or loss. So what are those things that can be seen on the face of profit or loss that will require adjustment? So income from interest in associates. This will be used to calculate the dividend from associates. That is item to be treated net of operating activities. So income from interest on associates will lead to an increase in the profit before tax. So we are going to subtract it. So we have income from interest in associates. That is 139 naira. We subtract it because it has led to an increase in the profit before tax. Now, back to the profit or loss. Loss on sale of tangible non-current assets. Loss is calculated on accrual basis. Since loss follows accrual basis, it does not involve the flows of cash. Remember, we said those items that doesn't involve cash, non-cash items, will require adjustment. So we are going to eliminate the effect. Loss has led to reduction in the profit before tax, so we are going to add it. Loss on sale of tangible non-current assets. Loss on sale of tangible non-current asset. That is 18. We are going to add it. We will add that. Back to the statement of profit or loss. Interest expense. Interest expense, interest charge as an expense is calculated in line with accrual basis. The interest paid is calculated in line with cash basis. So interest expense is an accrual item. That is why we will need to adjust for that here. Interest led to reduction in profit before tax, so we add it. So interest expense, that's amounted to 552. We add it because it has reduced the profit before tax. Now let's go through the additional information. Notes. Property, plant, and equipment. You have the cost. You have addition. Addition shows that there are acquisition of property, plant, and equipment during the year. Disposal shows that certain number of property, plant, and equipment were disposed during the year. Depreciation. This is the balance for the prior year, accumulated depreciation for the prior year. Then this is the amount charged for the year. Depreciation this is the amount charged as an expense. That means the depreciation charge for the year has been included in the expenses. Since it has been included in either a distribution cost or administrative expenses, that means it will have led to an increase in expense. An increase in expenses will have led to reduction in profit before tax. So since depreciation has reduced the profit, so we are going to add the depreciation. Remember, depreciation is non-cash item. So we have depreciation, and that amounted to 1,176. Note 2. Non-current liabilities. Year 4 and year 3 amount in thousand. We have 8% loan notes and 10% unsecured creditors. Note 3 is current liabilities. We have account payables and income tax. You are provided with the following additional information: interest on the 8% loan notes. This is interest. This is income tax. This is dividend. During the year, the Grape Group acquire 100% of the ordinary shares. This is the acquisition of the subsidiary during the year. This is the continuation of the information related to acquisition of subsidiary during the year. So, note 4 is the share capital. So, these are the items that will require the adjustment before the changes in working capital will be dealt with. So, minus 139 plus 18 plus 552 plus 1176. So we have 1607. 1607. So if you add it to 9550 plus 9550, so the total is 11,157. 157. This is net operating cash flows before change in working capital. The next item is to deal with change in working capital for the period. Change in working capital. Remember, under the working capital, you want to check the current assets with the current liabilities. So you may have increase in asset, we say it is negative, minus. Now, let's go through the current asset. The first item we have in the current asset is inventory. So year 3, 10,530. Then the closing balance is 11,657. Then acquisition of the subsidiary during the year. So we have inventory of 139. So let's check the inventory. We never knew whether it is an increase in inventory. I'm leaving a space for whether a space where we put increase or decrease. The opening balance, the one for year 3, inventory is 10,530 plus acquisition of the subsidiary during the year. From this, we have 139 plus 139. If you add this minus the closing balance, the inventory for year 4, which is 11,657 minus 11,657, 10,530 plus 139. We have 10,669, and the closing balance is still greater. That means we have increase in inventory. So if you subtract the closing one, 657, you have minus 988. Increase is minus. After inventory, we have in receivables. You never knew if it is an increase or decrease. That is why I'm leaving a space for that. How much is the opening balance of receivables? The opening receivables is 6,936, while the closing one is 7,209. 6,936, 6,936 plus acquisition. The subsidiary acquired during the year. How much is the receivable acquired? Receivables, we have 85. 85 plus 85 minus the closing balance. The closing receivable is 7,209. 7,209. 6,936, 6,936 plus 85 minus 7,209. We have 188. It's an increase. Increase minus. Increase in receivables. Then, after receivables, we have cash at bank and in hand. This is cash, so it will not be considered. Then we have current liabilities. Current liabilities. We want to look. We are given note 3. for current liabilities. Now let's go to note 3. We want to look at the composition of current liabilities. Current liabilities include accounts payables. So we have to be an increase or decrease in accounts payables. The opening is 6,219. The closing is 6,422. While the account payables acquired during the year is 68. So we have the opening plus acquisition, which is 68, minus the closing. So we have 6,219 plus acquisition, which is 68, minus closing, which is 6,422. 6,219 plus 68 minus 6,422. So we have increase as well, 135. This is liability. Increase in accounts payable. Remember, liability is opposite of assets. Increase in assets is minus, while increase in liability will be plus. Then, aside account payables, we have income tax. That is the only one. This will be adjusted in tax. So, what is the total of our working capital? So, we have minus 988 minus 188 plus 135. That gives us 1,041 minus 1,041. So if you subtract it from 11,157, then you have 10,116. After this, we have interest paid. Interest paid. If you look at your current liability, we do not have accrued interest or interest payable. We didn't have that as part of our current liability. Since there is no accrued interest, that means the entire interest expense has been paid during the period. So in that case, the interest paid will be the same as the interest expense of 552. But if you have accrued interest under current liability, the interest expense and interest paid will not be the same. So here I'm having interest expense. I've told you the reason why they are both the same. The interest expense and interest paid. I said they are the same because we did not have outstanding interest. We didn't have an accrued interest. But where there is an accrued interest, the interest paid and interest expense will not be the same. So then after interest, we have taxes paid. Taxes paid. Taxes paid. Then let me have that as working number 1. Working 1, we have taxes paid. As usual, we normally start with the opening balance or opening balances. Opening balances. You are going to check your current liability and the non-current liability. Then we didn't have any tax under non-current liability because it comprises 8% loan notes and 10% unsecured loan notes. We only have income tax as part of our current liability. Then, under acquisition, no tax was acquired. If taxes were acquired, then you will add the tax acquired, then before you subtract the closing balance. So we take the tax, the opening balance now, which is 2,400. The closing is 2,950. So we have opening balance, current liability, which is 2,400. That is the opening balance. Aside the opening balance, the tax expense in the statement of profit or loss will be added. Tax expense. By the time you add the tax expense, you now let the closing balance. Closing balance, which is equally found under current liability. Current liability. And the closing balance under current liability amounted to 2,950. 2,950. How much is the tax expense? Now, go back to the statement of profit or loss. We have income tax expense, 2,950. I've told you that of year 3, information we have in year 3 are not relevant. They are comparative figure. So we have 2,950. That is the tax expense, 2,950. If you add it to the opening balance, 2,400 plus 2,950, that is totaled 5,350. Then if you subtract the closing balance of 2,950, then you have 2,400. That is the tax expense and tax paid for the period. That is working number 1, 2,400. 2,400. So after this adjustment, now have net cash flows from operating activities. So we have 10,116, 10,116 minus 552 minus 2,400. So you have 7,164. 164. After operating activities, the next heading will be investing activities. I've told you that investing activities are activities that result in changes in non-current assets and investments. I've told you that whenever you get to this section of the statement of cash flows, the first thing you should do is to check the movement in non-current assets. You were told during the year, the Grape Group acquired 100% of the ordinary share capital of Pipe. The purchase was financed by 346,000 in cash, an issue of 54,000 ordinary shares of ₦1 each. There is a purchase of Subsidiary, which is Pipe, and it is 100% acquisition. That means there will be no non-controlling interest arising from acquisition, since it is 100% acquisition. The acquisition comprises cash consideration of 346,000 and the issue of shares of 54,000, ordinary shares of $1 each. So now, you were told the ordinary share had a market value of 152,000. So now let's calculate goodwill of acquisition of Pipe. Working number 2. Acquisition of Pipe. So we have consideration transferred, which comprises cash consideration of 346,000, then share consideration of 152,000. You will have added the NCI, but since the acquisition is 100%, that means there will be no non-controlling interest. The total consideration will be 498. 498. So the cash consideration and the share consideration of 152. Then how much is the total net asset acquired? The net asset acquired is 474. So net assets acquired, which is 474. So if you subtract the net asset and of 474, then you have goodwill of 24. This is the goodwill on acquisition. So the movement in goodwill. How much is the goodwill at the sanction of the accounting period? We are given intangible assets. The opening balance is nil. We ought to have opening balance plus acquisition. Acquisition is 24 as calculated in working 2. Opening 0 plus 24, we will still have 24 minus closing balance. 24 minus 24, that will be nil. So there is no acquisition, no amount written off of intangible assets during the period. Now, Remember, we are still on investing activities. We have property, plant, and equipment. Now, let's have movement in property, plant, and equipment. You were given the property, plant, and equipment, note 1. You have additions. That means you have some property, plant, and equipment acquired during the period. That is what you have as an addition, 1,875 during the year. Then, if 1,875 were acquired, then the subsidiary which was acquired during the year, you also acquire PPE of 315. So, acquisition that is 1,875 minus 315. The PPE which was acquired is 315. 1,875 minus 315. Then we have 1,560. 1,560 outflows. Or let me have working 3. Working 3. Working number 3. We have movement in PPE. So, in the movement of property, plant, and equipment, we normally start with the opening balance. Opening balance. How much is the opening balance of PPE? We have property, plant, and equipment. Opening balance is 12,990, while the closing balance is 3,515. So, opening balance 12,990, 12,990. Then acquisition of subsidiary. Acquisition of subsidiary. So the PPE which was acquired, we will equally have that. Then you have depreciation charge for the year. Depreciation charge for the year. You will see that in the movement in PPE. How much is the depreciation charge for the year? You have depreciation charge for the year, 1,176. 1,176. Depreciation will lead to reduction in PPE. Then we also have disposal of PPE. I've told you that the disposal that will be recorded is the carrying amount. Carrying amount. The carrying amount will be cost of the PPE less the accumulated depreciation. How much is the cost of PPE disposed? We have disposal at cost 429. The one sold in year 4. Then the accumulated depreciation. The disposal associated with depreciation is 255. 255. So we have cost of 429 minus 255. So 429 minus 255. How much is the disposal? 429 minus 255. That is 174. Disposal where PPE are disposed, that means PPE will reduce. So we subtract the disposal. There is no revaluation of PPE during the period. Then you consider the closing balance. How much is the closing balance of PPE? Closing balance. Closing balance of PPE, property, plant, and equipment, 13,515. The closing balance is 13,515. 13,515. 13,515. The subsidiary which was acquired during the year, how much was the PPE acquired from that subsidiary? We had that in notes. So property, plant, and equipment. Subsidiary which was acquired, the PPE acquired is 315. 315. So we have 12,990 plus 315 minus 1,176 minus 174. So that is 11,955. 11,955. If you subtract the closing balance of 13,515, you have 1,560. That is the acquisition. 1,560. That is acquisition of PPE during the period. That will be reported as investing activities. 1,560. Then the PPE which was disposed during the period, how much is the proceed from disposal of the PPE? Let me have that as working number 4. Proceed from disposal of PPE. Working number 4. Proceeds from disposal of PPE. The PPE which was disposed during the period. It was sold at what value? How much is the carrying amount? You are given the cost. The cost of the PPE which was disposed during the period. How much is the cost? You have 429. 429. The accumulated depreciation. Accumulated depreciation associated with the PPE which was disposed. Now, the PPE which was disposed, we have depreciation, disposal is 255. 255. If you subtract the depreciation of 255, how much is the carrying amount? 429 minus 255. Then you have 174. That is the carrying amount. Carrying amount. If 174 is the carrying amount, then the PPE, you have loss on sale of tangible non-current assets. It was sold at a loss of 18,000. So loss on sale of tangible non-current assets. The loss of 18,000. So where it is sold at a loss, the proceeds will reduce. So we subtract the loss minus 18. So the proceeds is 156. That is the cash proceed. This proceed will be reported as investing activities. So now let's have the investing activities. Proceeds from sale of PPE, working number 4, and that amounted to 156. That is an inflows. We also have investment that is associated undertakings. So we will need the movement in investment in associates. We have the opening balance and the closing balance. So remember, the movement in investment in associates will be used to calculate the dividend received from associates. Now let me have working number 5. Movement in investment in associates. In associates. As usual, we normally start with the opening balance. Opening balance. How much is the opening balance? Investment in associates, the opening balance amounted to 1,920, while the closing balance is 1,966. 1,920. 1,920 is the opening balance. Then we have share of the associate profit. Share. So we have income from interest in associates. That is 139. Income from interest in associates. And that amounted to 139. So we add it plus 139. So 1,920 plus 139. And that is totaled 2,059. How much is the closing balance? Closing balance under non-current assets. You have the closing balance to be 1,966. So if you subtract the closing balance, you have minus 1,966, so 93. That 93 is the dividend received from associates. That will be reported as investing activities. So now, let's recognize that dividends received from associates, that is working number 3 and working number 5, that amounted to 93,000. We've done with the items of non-current assets here. The subsidiary which was acquired, the purchase was financed by 346,000 in cash, and the issue of 54,009 shares of $1 each. So we have cash consideration of 346,000. Then the cash of 3,000 were equally acquired. So we have acquisition of subsidiary net of cash, acquisition of subsidiary net of cash. The cash consideration which was acquired is 346,000 minus the cash which was acquired is 3,000 minus 3,000. So we have 343. This is an outflows. Acquisition of PPE2. Acquisition of PPE is also an outflows. So we have minus 1,560 plus 156 plus 93 minus 343. So we have 1,654. So that is net cash flows from investing activities, which amounted to 1,654 outflows. After investing activity, the next heading will be financing activities. Financing activities. I've told you whenever you get to this section of the statement of cash flows that you should check the movement in equity shares. Working number 6. So we have movement in equity shares. As usual, we'll be starting with the opening balance. The opening balance is share capital 7,425 and share premium of 1,470. Opening balance. Opening balance. Share capital of 7,425. 7,425. Then share premium of 1,470. Then acquisition of subsidiary How much is the share consideration? So we will add that. Then we now have closing balances. We subtract the closing balances. Closing balances, which includes share capital, share premium. Closing balance, share capital, 8,100. Share premium, 1,989. 8,100 and 1,989. This is totaled. 8,100 plus 1,989. That is totaled 10,089. The subsidiary which was acquired during the period, how much is the share consideration? The ordinary share had a market value of 152,000. So the subsidiary which was acquired, the share consideration is 152,000. So we add that. So we have plus 152. So what is the total? 7,425 plus 1,470 plus 152. We have 9,047. To subtract the closing balance of 10,089. So we have 1,042. So that means there are issue of shares during the period. Issue of shares during the period of 1,042. So that will be recognized as investing financing activity. Issue of shares. That is working number 6. Issue of shares, 1,042. We are still on financing activity. Then we have accumulated profits. So now let's have movement, work number 7. Movement in accumulated profit. Opening balance. Opening balance. And how much? We have 8,700. 8,700. We have profit for the year. That is profit after tax. If you go back to the statement of profit or loss, we have the profit for the year of 6,600. So if you add that 8,700 plus 6,600, we have 15,300. How much is the closing balance? Closing balance. The closing balance is 13,200. 13,200. If you subtract that minus 13,200, then you have 2,100. This 2,100 is the dividend paid. Dividend paid. And that will be recognized as financing activity. So dividend working number 7. 2,100 outflows. Now, I want you to note that the information about dividend proposed were to dividends of 2.1 million and 2.4 million were proposed for year 3 and year 4 respectively. You know, the one for year 3, this 2.1 million is for year 3. And we are not preparing cash flow for year 3. This is for the year 4. We are preparing cash flow for the year 4. But the dividend proposed is different from dividend paid. Proposed dividend does not involve flows of cash. That is why the dividend proposed will not be recognized in the statement of cash flows because it does not involve the flows of cash. So we actually calculated the dividend paid from the movement in the accumulated profit for the period. Now, after equity, we have non-current liabilities. So we have note 2. Now, let's go back to the note 2. The note 2 include non-current liabilities, year 4 and year 3. So the 8% loan notes is constant for both years. So that means there are no issue of loan notes, and neither are there any repayments of 8% loan notes. But look at the 10% unsecured loan notes. The opening balance, we have 990, and the closing balance, nil. That means this 990 has been repaid here. So that is why we have nil balance here. So we are going to have this as an outflow in year 4 because it was repaid. So we have repayments of loan notes. Repayment, repayment of loan note. That is unsecured loan note. Let me put unsecured. Unsecured. That is 990. Outflows. 990. This is 990. 1042 minus 2100 minus 990. So we have 2048. That is net cash flows from financing activity. So we have minus 2048. 2048. Now, our investing activity is minus 1654. Minus 1654. 1654. Our operating activity is plus 7,164. We have 3,462. That is net increase in cash or cash equivalent. Cash equivalent. So we have 3,462. 3,462. We now add cash or cash equivalent at the beginning of the period. Then if you go through your current asset, you have 1,728 there. Under current asset, 1,728. If you add that is the opening balance, plus 1,728. Then you have 5,190. This is cash or cash equivalent at the end of the period. So this is the end of the solution to the question. Please drop the logo emoji and also share the video with others. Thanks for watching ZICA.